Good day, fellow investors. With Buffett selling stocks, Berkshire is turning into a stock market crash hedge. The current cash pile reaches a record of 325 billion for Berkshire. And we just discussed how he went last quarter up to 25% of assets in cash. He's now in more than 30%, and last time he did that, he predicted correctly the 50% crash. However, I want to discuss today the earnings, the last released earnings from Berkshire, the hedge effect that now is within Berkshire because of the huge cash exposure, and what will Buffett do with it when the next crash comes, and then also putting Berkshire into our value investing quadrant and discussing a little bit the difference between what Warren Buffett says to us and what he actually does. Let's immediately start with the earnings. As always, don't look at the investment gains or losses. Look at the operating earnings. Those have been up a little bit less than 4 billion, 3.5, 10% growth for Berkshire. That is a positive, and Buffett didn't do any significant buybacks, so he thinks Berkshire is overvalued. And here you can pause if you want to read his take on the earnings and the avoidance of taking into account the stock market gains, because that can be extremely misleading to investors who have little or no knowledge of accounting rules. What Berkshire focuses, what Buffett focuses on are the operating earnings. When it comes to operating earnings with Berkshire, those are after taxes, and those have been growing over the first 9 months, a little bit subdued over the last quarter, and this is because insurance underwriting is down significantly, but that might mean that Warren Buffett is also in insurance taking a risk-off approach, because he does not insure things if he doesn't see a good profit on it, and he simply says no if not profitable. All other insuring companies say yes and then go bankrupt every few decades. What is significant here is also the investment income almost doubling as Warren Buffett is moving more into cash, and what he gets from owning US treasuries as interest is accounted here as insurance investment income. All in all, when you sum things up, I think Berkshire will make it to 40 billion in earnings per year, and that is what I would take into account as average earnings over the Berkshire business cycle. But more importantly, from the last quarterly results is the cash position really growing, especially this money put into US treasuries and money put out of US stocks quarter after quarter. He has been selling and selling, especially Apple, and now the record pile is here if put at 4.72%, because he does invest in average 3-month US treasuries. That will give him 15 billion of insurance investment income if interest rates stay high. But interest rates are predicted to go down significantly, and so will the insurance income if Warren Buffett doesn't invest. But let's say an average 10 billion should be coming in even if rates go to 3%. When you also look at the hidden earnings, Berkshire owns Apple, but only the dividends are accounted into Berkshire's income. Warren Buffett doesn't like the expensive buybacks, and that's why he is selling. Nevertheless, all the earnings that are not in the form of dividends are, let's say, hidden and have to be accounted. When it was with Apple, we counted to 8 billion. Now with Apple gone, it should be around 3-4 billion of hidden earnings. Over the cycle, I think we can take 40 billion as Berkshire's average value creation per year. If we put that into a valuation compared to the market cap, we have a P ratio of 23. That is not a high earnings yield, but still better, let's say, than the market, and the earnings yield is now 4.21%. If we add Berkshire's growth alongside the economy of around 3%, we are still at a good 7% return, recession here and there, 5, 4, 6, 7% return. Still good for a company like Berkshire. Of course, the risk is valuation, because the average Berkshire P ratio is 15, we are now at 23, and we have seen lows of 10. If you think a P ratio of 10 is crazy, well, just go to my video of 4 years ago when I told you that it is a bargain price because the P ratio over the cycle, of course, was just 10. However, the most important thing with Berkshire now is that it is not an investment anymore like it was 2 years ago when the portfolio was mainly Apple. Now it is a hedge. Perhaps a hedge like it was in the 2000 period when the S&P 500 went down 42% from 2000 to 2002. In that same period, Berkshire went up 76%. Because Berkshire is a hedge, and it was also cheap then. But okay, look at this. The current position, the current cash position is 36% of assets. 36% of assets is in cash. And what will Warren Buffett do with that cash in the next crash? Well, in the next crash, Warren Buffett will do again a very, very big deal like he did in 2009 when he bought Burlington, and he got all his money back by 2015 through Burlington dividends, all his money back. And that's what Warren Buffett does. So if we make a calculation that he invests 300 billion into something in a crash, he likes to buy things with at least a 10% earnings yield when he acquires, dividend cash flow. Which means that his earnings, if there is a recession, we lower them down from 40 to 30 billion, add 30 new billion of earnings from his purchase, and that would mean that Berkshire's earnings in the next crash might jump to 60 billion. 60 billion, let's say P ratio of 20, that's 1.2 trillion in market cap. Keep in mind the S&P crashing 40-50%. And that's why Berkshire is now a hedge exposure in any portfolio. And now let's go into a funny discussion on what Buffett does and what Buffett says. Because this was a comment from Ethos here that Warren Buffett said, don't buy Occidental, that's for me. And then the stock just keep going up. Also, he told anyone, don't try to predict markets. Timing the market is more important than timing the market. What's he doing with 36% of assets in cash? Put again a little bit of the insurance, the businesses that he cannot sell. He's more than 50% of his portfolio liquid is in cash. That's timing the market, but from a perspective, not even timing the market, it's just fundamental investing. And that is the big difference here, because if you look at the holdings of the S&P 500, everything is extremely expensive, and therefore also Warren Buffett said, I don't want to spend 100 billion on buybacks for a 3% yield on a company that's not growing. 4% is much better from treasuries because it's risk-free. Apple can crash 50% at any point in time. Everything else is extremely expensive, and then there is only Berkshire that gives a hedge, so I would push this higher into any portfolio that has S&P 500 exposure. If we put this into a value investing quadrant, when Berkshire had Apple, I had it here somewhere in the portfolio because it was, let's say, market-like. Now that Berkshire doesn't have Apple anymore in the portfolio, now I have lowered the risk of it because the risk is lower from an investing perspective. Also, the return goes a little bit higher because it was 3% owning Apple. Now it is 4% owning treasuries and 10% when he will buy something. Therefore, Berkshire is now much lower risk than the market, let's say this being the market, a good stable return 5-6%, so somewhere here, and therefore Berkshire is now into, let's say, the buy part of the quadrant that we have here on the value investing channel. Hope you enjoyed this video. Check all my value investments on my research platform, and I'll see you in the next one.